This is the Darshan Talks podcast. Before this week's podcast, Insurance Losses and Healthcare Payouts, an interview with Kenneth White, Darshan will introduce this episode with a recap for the week of Thursday, July 2nd, 2020.
Welcome to another week of Darshan Talks. It's been a really interesting week in that there's been a lot of changes, or at least new nuances being introduced into the market. Several conversations I've had suggest that companies are becoming more socially responsible. You talk to Facebook and you talk to companies that work with companies like Facebook. Unless Facebook takes a stance on social responsibility, a lot of these companies are refusing to engage with Facebook, which has resulted in in a significant loss of advertising revenue for the company. However, that also raises the question about what role should companies play. To that end, there have been multiple companies that are coming in and talking about their role in social justice. One of them, Hindustan Lever, I used to have a product called Fair and Lovely. They've decided to drop that. L'Oreal is removing words like whitening from skincare products. So that itself speaks to this larger problem. At the same time, companies within pharma and health IT are looking and asking questions internally. For example, does more data equal better data? And that's been a question that people have always asked because generally speaking, Amazon and Facebook and Microsoft have worked off of the concept of, well, if I have all this data, I can do a lot of things with it. However, with GDPR coming in, you may not be allowed to have as much data as you want. It often goes to, do you actually need this data? Have you disclosed what you're going to do with this data? So maybe more data doesn't necessarily equal better health. There is another conversation going on around the idea of patient health. Pharma's reputation has improved during the COVID crisis. However, at the same time, there has been a discussion about, well, if individuals are losing money, the amount of money they have been able to contribute during the COVID crisis has dropped. Therefore, medical charities are starting to lose a lot of money, and therefore the support they give to developing new drugs starts losing money. At the same time, companies are also looking at new ways to engage with patients. Psychic Health launched a gamified meds management platform with Pfizer, which is kind of interesting as well. Speaking about COVID, Gilead actually finally came up with what it thinks its pricing might be, and as expected, there is a differential pricing between what it intends to charge in the US versus what it intends to charge globally. And it blames that on the way payers are set up in the US, which may be a larger conversation we have been wanting to have in the US for a long time. At the same time, as companies are starting to come back and forth, Verily and CVS Health are taking on the idea of the quote-unquote back-to-work healthcare screening market. What does that look like? What should happen? You may also remember a few weeks ago, there was an article I had highlighted about bringing the cost of bringing a drug to market. And I discussed it from numerous different angles, one of which was, does it actually cost $4 billion to bring a drug to market, or is it $2 billion? And this article actually discusses the limitations of the study that placed the price closer to $2 billion instead of $50 million, but criticized whether $2 billion was actually too low as well. There is an interesting other conversation going on in the context of health IT. Apple is taking this privacy-focused nutrition label approach for apps. And the idea is, what are you giving up? What rights are you giving up? So is that something that's going to take hold as we continue? Similarly, there is a discussion now about front-of-pack nutrition labeling if you produce and market food products. So that's going to be something that's interesting as we continue. In the context of patient centricity and patient engagement, the government has sued Regeneron for pharmaceutical copay kickbacks, and that really goes to how you engage with patient groups and are there limitations on ways you can do it. Speaking about patient groups, cost of drugs, one of the big issues you face in that context is the idea of gray market drugs entering the US market, black market drugs entering the US market, and those products may or may not be authentic. Therefore, ColorCon actually came out and launched a drug authentication platform that talks about this. If you have other questions, if you think I have missed a news article that may be relevant, please feel free to reach out to me. You can reach me at Darshan Talks, or you can find me on Twitter at Darshan Talks, or you can just go to darshantalks.com. I look forward to hearing from you.
This is the Darshan Talks podcast. Regulatory guy, irregular podcast with host Darshan Kulkarni. You can find the show on Twitter at Darshan Talks or the show's website at darshantalks.com.
Hey everyone, welcome to another episode of Darshan Talks. We have our guest, Kenneth White, and he is from Willis Towers Watson. However, I do want to make clear, he doesn't represent Willis Towers Watson right now. He's just talking, that just happens to be where he works. We had a really interesting conversation with him previously about his entry into being in-house. And now we wanted to get a little bit more into details to talk about just how does insurance payouts right now with COVID going on. There have been a lot of discussions around the idea of, well, will my insurance pay my claims? I've got a ton of business losses that I need to offset or at least offload. And is that really possible in this world? And then there's a whole discussion around payers, and we'll see how far we get. But Kenny, you want to do a quick introduction for yourself?
Sure. I'm Kenneth White. I'm the National Managed Care Practice Leader for Willis Towers Watson, which means I oversee the group of people who provide corporate risk and broking services to the managed care industry. I'm a healthcare lawyer. I practiced as a trial attorney for 28 years before I took this job 6 years ago. And as Darshan said, I am not speaking on behalf of Willis Towers Watson.
Very cool. So let's ask the big question of the day. How are insurers dealing with the idea that, you know what, I bought business insurance. I, in some cases, even have that it'll cover my cover cases like SARS, which happened to be, I think SARS was a coronavirus. So why are my COVID losses going to be covered? And again, we're not talking about Willis Towers Watson in this specific instance. We're talking about just generally, how is the insurance industry dealing with this?
So Willis Towers Watson primarily is an insurance brokerage entity. So we don't actually provide the insurance. We work with entities for that they will have the right insurance and the right amounts from the right companies. But people who run insurance companies traditionally are not dumb. So when communicable disease outbreaks happen and they are left holding large claims that they have to pay out for which their premiums were not actuarially determined to include that risk, they are now in what they refer to as an upside down, or you could think about it that you do your lease. I only got in, $100. I've got to pay out $200. This was not a good deal for me. Right. So they will use language, terms, and conditions to exclude certain claims from coverage, so that when the mold and mildew claims came about a number of years ago, you saw significant numbers of exclusionary terms and conditions coming into property claims, especially GL claims, general liability, or umbrella policies to eliminate a claim being payable for mold and mildew. Same thing when the SARS, swine flu, bird flu, whatever we called it before, when that happened, you saw another crop of coverage terms coming out in insurance policies to limit the insurance carrier's exposure to that type of a claim. You see the same thing in cyber, where your traditional professional liability or E&O, errors and omissions coverage, would provide you breach coverage. They have eliminated that almost entirely now as the network security and privacy, most of us call it cyber, insurance industry has become mature. You can still get the coverage. It's just not going to be under that policy. It'll be under your cyber policy. So with COVID, obviously, the first things that people think about are either health claims or they think about property claims. My company had to get rid of everybody, clean our offices 19 times, We lost use of all of our facilities. We may have lost income as a result. We may have had a number of people who got sick, et cetera. So if your employees got sick, particularly if you were either in a state that has expanded the definition of workplace injury recently to take care of this, or it was actually acquired at work, then your workers' comp coverage would provide the cover for the employee that got sick. If you had to vacate your premises because of the lockdown, or other words, if you had that type of coverage in your property cover, your property policy, you may be able to recover amounts associated with business loss, loss of income, cleaning expenses, having to set up half of your workforce or most of your workforce at home versus in the office, those kind of things. But many property policies excluded biologic agents because of what I said before, mold, mildew, and SARS, that you may not have that type of a claim. Same thing with GL policies and umbrella policies that would sit over the top of it. And then you have your health and benefits policy that might protect your employees for their health. And obviously, if they needed medical care and treatment, then those claims or losses would fall under the health insurance. So there's lots of little buckets out there. The question for most industries, for instance, if we have clients that have thousands of employees and 10 or 12 buildings on a campus. And I'm not talking about hospital companies, I'm talking about managed care entities that had to send 90% of their workforce home. Well, do they have coverage for the cleaning expenses of all of the campus so that when the people come back, they don't get infected? What happens if they lost income? One of the nice things, I guess it's nice for the managed care industry, is that in most cases, people still have to pay premiums to get insurance, and the managed care companies are still obligated to pay claims. So there isn't a lot of business interruption loss for a managed care company versus, say, an entity that runs ambulatory surgery centers. Right. That had to close completely for 3 months because they weren't providing essential services. Now that's a business interruption loss. So it really kind of depends on the industry, but there were lots of different options out there. Getting that coverage in the future is going to be very difficult.
Interesting. So as an industry, this is now going to be something that has to be considered and will actively show up in future policies and may actually get actively excluded, or you have to buy special coverage for it, is potentially the direction this would go.
Correct.
Now,
the problem is that in many cases, there are often options, but the cyber option that I brought up, ransomware, those kind of things, where you may have had coverage under a property, they call it silent cyber coverage because it wasn't specifically excluded. There were arguments that it was included. And then people got wise to that and they started making specific exclusions for those kind of things. But you could go buy network security and privacy cover, which covers all of those things. So the insurance was available. It just had to be available in a different package. With COVID cover, there may not be an alternative unless the federal government passes legislation as they had, it's called TRIA, the terrorist backstop policy, FEMA for flood insurance, the National Flood Insurance Program. If they pass one, and there is legislation in Congress at the moment that would do just that, create a backstop insurance pool whereby people could make claims against that pool because they couldn't get insurance commercially for it.
So that makes sense going forward. But here's my question. What happens to those who are upside down right now? because you're upside down right now for hundreds of thousands of people and huge businesses. Do you still pay out? Because that might just shut you down now. Even if you've learned from the situation, it may be too late. Or how have you seen that being handled?
Well, the biggest bulk of the claims so far have been in the property arena. The property insurance fund pool globally is backstopped by commercial reinsurance. And while it may hurt some of the larger companies that have significant exposure to this, it's not going to cause a downfall of the insurance industry.
Oh, interesting.
I mean, the insurance industry handled all of the hurricanes we had a couple of years ago. They handled all the fires out in California. There's not going to be a major disaster in the insurance industry because of the claims associated with COVID.
See, I didn't know if COVID was hurricane times global, and
no.
Therefore, it's not seen as that. Okay.
No.
Okay.
I mean, I'm a lawyer, so people say I don't have a heart. But I mean, we've had a couple of 100,000, 150,000 people die in the U.S., but there's 350 million people that live here. Yeah. Is it bad? Yeah, it's bad. Particularly if one of those 150,000 people was in your family or one of your loved ones. Yeah. But for most of us, we don't know people, who have died because there's 350 million of us and there was only 150,000 that have died. Globally, well, whether you believe the numbers or not, I mean, there's 7.8 billion people on this planet, and they claim that only, a couple of 100,000, 300,000 have died. If you made that number 5 million or 10 million, I mean, the Spanish flu pandemic in the 1918s, 19s killed up to 60 million people, which was a large percentage of populations of certain areas. This is not that. Does anybody want to die from it? No. It caused a great deal of financial angst as well as emotional and physical angst. Yes, it has. But it's not going to bring the insurance industry to its knees.
That's really interesting to me because, again, that was one of the questions we always asked. And you mentioned the reinsurance.
Wait, Darshan, real quick, just one thing, real quick. Please. Look at the Payor industry, the Aetnas, the Cignas, the United Health Groups, all the Blue Cross Blue Shield plans, all of those people. They're financially sound. They were financially sound before this. They will be financially sound after this because, one, the pressure on their claims payouts wasn't as bad as anybody projected to start with, even with all of the addition of what they're paying for that they weren't originally obligated to pay for, no co-payments, no co-insurance, that kind of thing for COVID care. But all of the care that wasn't being provided in the last 3 months, they would have paid for. So those claims didn't come in.
Right.
So their numbers in the first quarter plus of 2020 are almost identical to what they were in 2019.
I actually heard they were better.
They may be better. So
I was going to ask you about that. That was one of the questions I was going to get to, but please continue.
No, so I mean, everybody's kind of that whole rubber band, snapping concept that people think when you wrap a rubber band up and it pops and let go of it, it pops. I mean, people are considering what happens when everybody floods in to get the care. Well, I think one that's going to be somewhat of a trickle effect. I don't think it's going to be people rushing in to do it at all, because some people are still afraid to go to the doctor's office, to a hospital, because they're fearful of contracting an illness because that's where the sick people are. They've also been told for months now that our hospital and health system has been overrun by COVID, which is not true because they've laid off thousands and thousands of idle workers. The emergency department encounters for the first 4 months of 2020 are 50% lower than they were last year. Not higher, lower.
Right.
So, the hospitals and the doctors and those, they're hurting. They're hurting because they don't have anybody coming for care. If they don't have anybody coming for care, they've got all these fixed costs and labor costs. They don't have any revenue coming in.
Right.
They're begging people to come in and get health care. And when that happens, it will, of course, equalize on the payor side, but it won't be a major problem for them.
Which really raises the question that you raised, right? So I have two different questions. One's a short one, one's a longer one. The short one, you talk about reinsurance. Could you explain what that is?
Reinsurance is a insurance contract where an insurance company goes out and buys insurance against its losses. So if I am Allstate, and I insure something, and my obligation for that is $10 million or $100 million. I can go out to a reinsurance company and buy insurance on whether or not I have to pay out the money or not. It's legalized gambling. I mean, I'm making
it's like going to an insurance company and saying, if I gamble and I lose, I want you to pay me out.
Yeah, but you pay a premium.
What the Lloyds of London does anyways?
That's exactly what Lloyds does. Okay. So I mean, Lloyds started, I believe, as like a shipping insurance industry because people kept losing the ships and the cargo on. So Lloyds started out that way, and you had a syndicate. People bought into it. I'll take 10% of that loss, and I'll take 20%. And so what happens is that if I'm AIG and I'm laying out all of this money everywhere, I have to be able to pay it. It's a regulated industry, so I have to have reserves somewhere to make sure that I can pay out. But if everybody made a limits claim on AIG all at once, it would go under in a heartbeat to the tune of 1 million times because they don't have that kind of money lying around.
Right.
They don't have the assets to do that. What they have is reinsurance treaties. They have agreements that say, I'm exposed over here to X number of dollars. If I have to pay that out, I want you, reinsurance company, to pay me back. I will pay you a premium for that. So you're basically I'm taking a risk on whether there will be a loss from the insured, and you're taking a risk, reinsurance company, on whether or not first insurance company, have to pay insured.
But then wouldn't every loss directly go to the reinsurance company? Because every time there is a payment to be due, you just go to the reinsurance company and say pay out. Then why don't I just go to the reinsurance company?
Well, two reasons for that. One, a thing called a retention or deductible. You have an auto insurance policy. You could have a deductible of $250 or $1,000 or $5,000. So that's your money. On these other things for property claims or in my world, in a managed care world, for E&O claims directly against a managed care company, the retentions, and there's a slight difference between a retention and a deductible, but we don't need to talk about it right now. That part can be anywhere from $500,000 to $50 million.
Okay.
So the first $500,000 to $50 million isn't the insurance company's money, it's the insured's money.
Okay.
Same process works in reinsurance.
Got it.
They have what's called attachment points. So I'm not reinsured to $1, although you could have that type of arrangement. Most people do not, because your premium would match what your payout would be. You'd have a $10 million policy and the premium was $10 million. So people will have attachment points. So not every claim would find its way to a reinsurance company.
Fascinating. Thank you. So let's pivot a little bit and very shortly talk a little bit about the concept you raised, which is right now a lot of everyone talks about how insurance companies are going to come to their knees because there are so many more payouts, and you explained that's not always the case, and that may not be applicable even in this situation, even though the entire world shut down. But But then there was this other piece you discussed, which was some insurance may have actually come out ahead. And you hear about Geico saying, you know what, you guys haven't been driving. Here's 15% of your premiums back. And you see people who are in the healthcare industry going, I'm not doing any elective procedures. Do you see payers of healthcare premiums going, you know what, let me give you some of the money back?
Yes.
Interesting. Why do that? Why not just lower premiums next year?
There's several reasons for that. One, you may not have the same insureds next year. You know, if an employer swaps to a different company, or you have individual coverage through the ACA, or you're on a Medicare plan. Couple of reasons for that. One, it doesn't make good business to keep the profits. You're in a highly regulated industry that is very, very visible, both to politicians and to the public. So anything that you can do that does not adversely impact you in a large way in order to raise your standing in the community and be a good corporate citizen, you know, most businesses will do that, including insurance companies. Insurance companies are not the world's most treasured of industries to begin with. And so they always like to do something that they can, you know, raise the public's perception of them. Two, in network building. So if I'm an insurance carrier for health insurance, I have to have an adequate network to provide the care that I'm obligated to provide to my members. So I go out and contract with, or I employ physicians, hospitals, diagnostic centers, et cetera, to provide the care so that I get a better price on what I'm paying for. So a lot of those entities are hurting financially now, but it doesn't help you know, an Aetna or a Cigna or an Anthem for their network to go belly up. They need those people. So they are doing similar things like what CMS is doing on the Medicare and Medicaid side of providing advanced payments to their providers to make sure that they're able to pay their bills.
Oh, that's really interesting.
Blue Shield of
about that before.
Yeah, Blue Shield of California was even guaranteeing loans for some of them.
Wow.
To make sure that they were going to still be in business when this ends and the people come back to get health care. Because remember, Blue Shield of California is still obligated to provide the care and treatment that its members seek. And it has to be able to provide that. So having hospitals or doctor groups or diagnostic centers, pharmacies go belly up is not helpful to them. They need those people. So they're doing what they can to help, you know, within reason,
so are
provide.
These like no interest loans, or are these like a stat market interest? Or how does that work right now? Right now, market interest is no interest, but still.
On the Blue Shield side, I'm not sure how that's being done. On the advanced payments, it's just advances against future payments. So if it's a cash flow, it's interest free. Okay. I mean, so if I anticipate that I'm going to pay you out, you know, $2 million over the next 6 months, I'll give it to you $200,000 a month, even though you haven't earned it right now. Right. Because when you start earning it later, I can take the money off of what I would pay you. It's a cash flow thing.
You wouldn't do it though in bulk. You would actually still string it along and go.
No, it's a cash flow maneuver. So they're doing it, you know, month to month.
Got it.
And some of the insurance carriers have offered or are giving discounts, which are like the auto companies. They are reducing their premiums X percentage per month on their vision coverage, on their dental coverage. Not as much on the major medical, but some on that as well. But mainly on the dental and vision. And one of the reasons for that is people aren't going to the dentist.
Well, here's the question. What are they giving that to pharma as well and drug distributors?
You know, pharma isn't your most loved industry these days.
No.
It's one of your most needed. Anybody that's paid any attention to the mad dash to create a vaccine or treatments for COVID-19, you know, that's all pharma.
Yeah.
Now, you know, unfortunately, we've gone through multiple years of huge price increases in pharma. a lot of business structures that were designed to maintain patents, to prevent generic drugs from coming to market, and then 300, 400, 500, 1,000% increases on medications. So the public's not really all enamored with helping pharma out. The good thing about that is, pharma the major companies really don't need it. It's not like CVS is going under tomorrow.
Right.
The problem is that what had been going on for years, the loss of the mom and pop pharmacy, that has accelerated significantly.
What about your manufacturers? Like, I have had clients who said that I've had to shut down, or I've had, like, because the smaller companies are working with cash flow basically, and obviously this dampens.
Yeah, the smaller generic, manufacturers are probably having trouble. Mainly because of
or anything for the most part.
No, I haven't seen that at all.
Interesting, fascinating. Kenny, we can keep talking, but obviously we should schedule one more of these because this was super fun. So, any parting words?
No, just everybody, wash your hands. Keep your mask on. It's to protect others, not necessarily you. Social distance. I can't stand it either. I would love to go protest being locked in my house, but there are people out there that are susceptible. There are people out there that will get sick, and there are people out there that will die. And anything that you can do that's not terribly inconvenient or a hardship to you, staying out of large groups, washing your hands, which we should all do anyway, wearing a mask in public, is a small hardship on you to help protect others. So that's my parting words.
Awesome. Thank you again, Kenny. This was awesome.
All right. Take care.
This is the Darshan Talks podcast. Regulatory guy, irregular podcast with host Darshan Kulkarni. You can find the show on Twitter at Darshan Talks or the show's website at darshantalks.com.